Silicon Valley Bank has been taken over by federal regulators at the FDIC, and President Joe Biden made an announcement today that taxpayers will be completely immune from having to bail out the SVB. So is that true? And what legal precedent allows the president to make that guarantee? My name is Drew Page. Welcome to the Drew Page channel. In this video, we are going to talk about the breakdown at SVB and the president's remarks, as well as the Treasury and the Fed and several other regulators, and how it is that taxpayers may be able to avoid having to pay at least a tax or having taxpayers being responsible in the sense of the government bailing out the bank versus taxpayers instead having their bank fees increased. If you found this video helpful, please like the video, subscribe to the channel, hit the notification bell, and all that good stuff. So let's jump right in. So over the weekend, it was determined that Silicon Valley Bank had risked basically a very substantial amount of its deposits in Treasury bonds in the hopes that they would be able to grow a higher interest rate. And unfortunately for them, the interest rate, when the Fed began to grow, raise the interest rate hikes, the treasuries began to decrease in value, and the bank essentially became over leveraged. Well, there started to be a run on the bank. The deposits were not available to meet the demand, so SVB had to sell off those assets at losses, and because of that, federal regulators had to jump in to make sure that deposits could be protected. Now, the FDIC insures deposits in an amount up to $250,000, which means that anything above that is no longer protected. Well, President Joe Biden came out today and indicated that the FDIC was going to insure all of the deposits, not just the ones that are $250,000 or less, but basically has made sure that the wealthy companies and wealthy people who he claims doesn't pay enough already and that he is against, for whatever reason, he has decided he's going to protect them and make sure that they have all of their funds available, and they were made available today. Now, he gave a statement this morning also saying that taxpayers would not be bailing them out. No taxpayer dollars would be used to help insure those deposits. Rather, what would happen is a special assessment would be made against the banks. Now, when you read the statement that was given by the president, and he basically read the same joint statement that Treasury Secretary Yellen, Fed Chair Jerome Powell had also joined in, and you can see that statement at the FDIC website as well as Department of Treasury website. Essentially, it says that a special assessment will be made against the banks as prescribed by law. So what is the law that says that special assessments can be raised? Under 12 U.S.C. Section 1817, the FDIC has express delegation of authority to regulate and establish risk-based assessment systems. And they also believe they have implied authority under the Federal Deposit Improvement Act, Section 7B5. So with those delegations of authority, Congress has essentially allowed the FDIC to be able to make determinations in their discretion, as long as it's not capricious and arbitrary, to set special assessment amounts. Now, that has not gone without challenges. Many of the large banks have fought against it, saying that it is an unconstitutional delegation of authority. However, to date, the FDIC does have that ability. So they are going to be able to raise funds from banks by these special assessments. So if they are able to raise enough money from the banks through these special assessments to cover the deposit insurances so that the depositors are able to have all their money, then yes, taxpayer funds may not have to be tapped into. But we also know that Signature Bank has fallen. They've made the same claim. Are there any other banks that are going to fall out? I mean, at some point, the special assessments you're only going to be able to hit so many banks with so much money. So what are they going to do then? And so that'll remain to be seen if there are any other banks that fall by the wayside. If there are, then there is some potential that ultimately the taxpayer is potentially on the hook if the special assessments are not adequate to meet the need. Obviously, that would have to take some sort of congressional act. But there is authority currently that has been delegated to the FDIC to raise special assessments on banks. So at this point, it may be true what the president has said, that the banks will be responsible for insuring the deposits, not the American taxpayers. That will remain to be seen. However, that also means that if the banks are paying these special assessments, that means that their profits are lower. They're going to raise that on fees, on other ways. So even though we won't be paying tax to the government, the citizens will likely be paying more fees to the banks to cover the losses that are going to come from these special assessments. So in the end, we all get it anyway. But that's basically the legalities of it. If you found this video helpful, please like the video, subscribe to the channel. Let me know in the comments what you think. Do you think the taxpayers are ultimately going to be responsible for this? And if so, why? Let me know down in the comments. And until next time, stay tuned.